Welcome to the Leaders in Payments podcast, where we talk to C-level leaders from across the payments landscape. We'll be discussing the products and services that impact the payment space today, as well as trends and predictions for the future of payments. We will also hear stories from our guests about their journeys to the top.
So we give control to the supplier in this case to name their rate, when they want it, how they want it, and at the price they want for their working capital. And then we take all of those bids. We receive roughly 50 million approved invoices every night from the world's largest businesses. We match 2 trillion of AP and AR. We allow that supplier to name their rate, and those rates are vastly different. A small business may be offering 7%. A larger business with a credit facility tied to SOFR or LIBOR in the past might offer 2%. We're trying to find in our marketplace the right rate to satisfy every consumer of that capital. Not a homogeneous platform, but a heterogeneous platform of price discovery where every supplier gets to put in a rate that works for them.
That was Sandy Kemper, the CEO of C2FO, and he is our special guest this week on episode 172 of the Leaders in Payments podcast, and I'm your host, Greg Myers. Sandy is a self-proclaimed black sheep recovering banker who is still trying to figure out how to make the world a better place and save customers money on the cost of doing business. C2FO is a decentralized financing platform that services approximately 1.3 million customers across the globe and across all verticals. Their mission is to provide low-cost, convenient capital to everyone that needs it, and they are driven by a passion to help companies find ways to grow their business. Sandy and I talk about his journey to becoming the CEO, including what the next 2 to 3 years has to offer as it relates to more transparency and reduced friction in payments and financing, where crypto and blockchain fit in the space, as well as the advantages C2FO offers to diverse business owners. We've got a great episode ahead, so let's get started. Hi, Sandy. Thank you for being here, and welcome to the Leaders in Payments podcast.
It's a pleasure to be here, Greg. Thank you for having me.
All right, well, let's dive right in. So tell our audience a little bit about yourself, maybe where you grew up, where you went to school, where you currently live. We'll jump into your professional career in a minute, but maybe a few of those things to get us started.
Well, it's a long time ago when you asked me where I grew up and what schools I went to. I'm probably older than most of the folks you interview on the show, but grew up in Kansas City, went out to school for high school on the East Coast, went back to Chicago for university, then began my career as a banker here in Kansas City. And I guess I spent 13 years there and then went on to go build e-commerce and B2B businesses and others. And one of them that we'll talk about, of course, is C2FO, which is a little bit different than what I'd done before. But in a nutshell, I'm a recovering banker still trying to figure out how to make the world better.
Awesome. Well, let's go ahead and talk about C2FO. So tell us what the company does.
Our job is to find ways to bring capital to companies who need it so that they can grow their businesses. We want to provide low-cost, convenient capital to everyone who needs it. So our platform matches accounts payable and accounts receivable, allowing those folks who have the accounts payable to pay early the folks that have the accounts receivable.
Okay, and are you a global company?
We were fortunate enough to land a very large company back when we were only 7 people or so in our shop, and be careful what you wish for. We ended up being global from day one. So we've built a global platform that operates with customers in about 180 countries. We operate in something on the order of 60 currencies now and almost 30 languages.
Okay. And then how do you go to market? Do you have a direct sales team or partnership channels or a little bit of both?
So our job, as I said, is to match the world's accounts payable to the world's accounts receivable, eliminating, therefore, the need to risk underwrite the account receivable. So when I was a banker, I would look at companies' accounts receivable and inventory and find ways to provide capital to them, but I was risk underwriting them. Now, if you take the bank out and you allow for the company who has the accounts payable, which is, of course, the other side of that account receivable, to pay early, then you don't need to risk underwrite. You don't need to have filters or gates or hurdles or any factor relative to limiting the flow of capital. So our sales motion is to find the largest companies in the world, put them onto the platform, and then light up all of their suppliers and or some of, and perhaps even all of their customers on the platform so that we can do price discovery on our marketplace relative to early payment of accounts payable, or maybe even receipt of later payment of accounts receivable from that company's customers. So if you think about trade debt being AP and AR, and you think of a large company in our world as a center node, let's say it's a Costco or an Intel or an HP, those are center nodes. Well, they all have customers and they all have suppliers. Until we built our platform, there was no way to dynamically find price for early delivery of cash flow to the suppliers, or perhaps allow for later delivery of cash flow to that center node from their customers. So it's a marketplace that allows both suppliers and customers to name their rate for the working capital they need. Working capital may come in the form of early payment that the supplier needs, and it might come in the form of slower payment from the customer. So it's ways to generate cash for what we call the edge nodes. The edge nodes are the customers or the suppliers of that center node.
Okay. And you mentioned some pretty large companies there. Are there specific types of companies or verticals that you seem to serve better, or are your target customers?
Well, we were lucky when we started the business. I mean, as a banker, I was always a little bit of the black sheep at the bank, trying to find ways to lower cost to our customers. And it turns out, of course, that the world's working capital market is a lot larger than I imagined when I first started. I was really just trying to find a way to manage low-cost, convenient capital to companies. Except, of course, you couldn't do it when you were a bank because you had to risk underwrite. Well, the total economic output of the world is around 240 trillion. Final economic or final GDP is about half that, about 120 trillion. But you've got iterative trade between businesses bringing you to that 240 trillion. On 60-day payment terms, which is kind of par for most businesses all around the world. You'll have shorter payment terms in the United States, longer payment terms in India or China. But roughly 60 days payable would mean on any given day you've got, 40 trillion of accounts receivable or accounts payable on the books of businesses around the world. All of the banks in the world, all of the supply chain finance companies, all of the factors, all of the ABLs that are trying to create liquidity against that 40 trillion, total to maybe 4 trillion. So you've got a huge vacuum. 36 plus trillion opportunity set here that, of course, I was happy to discover when we started the company, but I was just trying to solve a problem for more efficient delivery of working capital for a subset of that population. Today, we serve 1.2, 1.3 million customers, as I said, all around the world, brought to us by our partners, who are those large center node buyers across all verticals: tech, logistics, transportation, auto, aerospace, retail. We started in retail. As I said, our first Fortune 10 company was Costco. They gave us a wonderful start back when we only had 7 people in our company. And we built a global platform, of course, because they had suppliers all throughout the world. And from there, we've grown to have almost 70% of the U.S. retail market on our platform. Lower percentages in other market areas, but still a high amount of business in our tech vertical, CPG, logistics, all in the 20 to 30% of U.S. Since we started in the U.S., our penetration is higher in the U.S., but we're growing very rapidly in India and all throughout EMEA as well.
So you see, obviously, the big companies like you've been talking about, and they bring their supplier sort of network and customer network. So then you're talking about smaller businesses. So can you talk about sort of the makeup of that maybe smaller business segment?
One of the problems, I think, with traditional supply chain finance, which is not what we do, but just talking broadly about the industry, it tends to focus on a very small set of very large, somewhat credit risk or higher priced credit suppliers. We can manage that on our platform as well, but because we're a marketplace, because it's 2 clicks to cash, because it's very easy to enable all of those suppliers inside that supply chain, we're much more holistic than any other financial solution a center node might want to bring to its suppliers or its customers. So there is no impediment nor need for us to KYC or AML the suppliers when all we're doing is enabling them to be paid early. So the introduction of the intermediation of a bank and the necessity, therefore, of AML, KYC, and other underwriting processes limits the flow of capital rather dramatically, as I said earlier, to those folks who would like to get it. Because we eliminate the need to risk underwrite, everyone in the supply chain, everyone in the customer chain can receive working capital regardless of their financial condition, because you're not risk underwriting them, you're simply paying them early, or you're allowing them to pay a little bit later.
Okay. And then what is your pricing philosophy? Is it sort of set up as a SaaS model, or how do you price?
We price in 3 ways. There's an implementation fee, a subscription fee, and transaction revenue, but about 95% of our revenue is recurring, either subscription or transaction, with the vast majority being transaction. And transaction revenue is a revenue share against that which we generate for that large center node business, as I said, a Costco and Intel and HP and Amazon, et cetera. So if they're going to make X, we'll take a percentage of X as our revenue. Now, we do not charge our suppliers. They're able to participate in the market for free. As I said, we have 1.2, 1.3 million of them. As you imagine, that a large percentage of them are quite small. So we wanted to make this very easy for them to use. It is 2 clicks to cash. They're able to see what they're going to be paid by their customer and order early payment at a small discount, if they choose to give one, to their buyer in order to incentivize them to pay early. And that average discount last year in the United States and abroad, so the U.S. numbers were a little bit lower, but our total discount pricing was around 48 basis points, or roughly 5.2% APR. So last year we enabled almost 60 billion of funding to businesses all around the world at an average APR of 5.2%.
Okay. And what would you say differentiates your company from your competitors out there?
Well, it sounds silly to say. I'm sure there are lots of folks who could be competitors. We've had the grace of having a rather significant head start. We are the only marketplace for working capital. We are the only marketplace that has the capacity to allow for the receivers or users of that working capital to name their rate. We actually patented that. So across this diaspora of 1.3 million businesses, every supplier can name their rate for the working capital they need. So if I'm borrowing at 6%, I might name a rate at 5. If I'm borrowing at 9%, I might name a rate of 8. Our job isn't an equal rate the way static discounting is. Our job is an equitable rate according to the rate that that supplier or customer has in the traditional market at that time. Now, this gets kind of interesting because there are, of course, times when companies don't need cash. Let's say you're a seasonal manufacturer. Well, peak season, you may need cash. After that's in and you've been paid, you may not need cash. The problem with static discounting is that the static discount, the 210 net 30, is something that the buyer takes, not something that the supplier takes or initiates. So we give control to the supplier in this case to name their rate when they want it, how they want it, and at the price they want for their working capital. And then we take all of those bids. We receive roughly 50 million approved invoices every night from the world's largest businesses. We match 2 trillion of AP and AR. We allow that supplier to name their rate, and those rates are vastly different. A small business may be offering 7%. A larger business with a credit facility tied to SOFR or LIBOR in the past might offer 2%. We're trying to find in our marketplace the right rate to satisfy every consumer of that capital. Not a homogeneous platform, but a heterogeneous platform of price discovery where every supplier gets to put in a rate that works for them.
Okay. And where do you see this space headed? So let's not say payments, but let's say the space you're playing in. Obviously, you may not have too many direct competitors, but you have other people solving the same problem, but in a different way. So where do you see all that headed, say, in the next 2 to 3 years?
I think in a perfect world, and sometimes, of course, we live in a very imperfect world, but as time passes, more transparency. Transparency will reduce friction. So I see markets evolving in a way that reduce friction, reduce intermediate costs through more transparency. I think in our world, we'd like to go from matching 2 trillion of accounts payable and accounts receivable. So it's actually 4 trillion, 2 trillion of AP, 2 trillion of AR. We'd like to get that to be 20 trillion in the next 10 years. Last year, as I said, we did almost 60, we did 55 billion in funding. This year, we'll do 100 billion in funding. We think in aggregate, we'll be able to say in the next 4 years that we've enabled 1 trillion of funding. And what we've done isn't rocket science. It's an understanding that more transparency, in many ways, you could consider what we do decentralized finance in a way because we're not going to a central node for financing. There is no intermediation of capital. It's between those who are the center node and the edge node. So in many ways, I think you could think of us, if you wish to, as one of the largest, if not the largest, decentralized finance platform in the world. We don't engage in crypto, and it's not on the blockchain. It's on our ledger. But I think this idea of more transparency, less friction, more openness, more market-like fluidity is going to be prevalent 2, 3, 4, 5, 10, 20, 30 years from now. It just doesn't make any sense to have these silos that the old world insisted on building and then maintaining. I think we're going to see those silos break down. I think we're going to see a much more decentralized flow of information and much more transparency.
Yeah, and you mentioned a couple of key words there that we often talk about, cryptocurrency and blockchain. I mean, how do you see those affecting your business in the long term?
We thought a little bit about whether we would want to open up our ledger, and we're still playing a little around with it, but right now it is a private ledger, and it is a ledger that is we run basically between buyers and suppliers for flows of capital. And as I said, center nodes and edge nodes, if you want to use that vernacular, center node can have suppliers, center node can also have customers. Remains to be seen. There are some challenges relative to the dissemination of information, which would be material non-public information. I mean, if you think about what we receive inside our marketplace, 50 million promises to pay from 375 of the Fortune 1000, 75 of the Fortune 100. So we are very careful with the data that we have. And I think if that were to be put out into the public, it would be very problematic. So for now, a private ledger makes a lot more sense.
Okay. And most of these companies, so you're talking about these large Fortune 100 companies, they typically have some sort of ESG initiatives, environmental, social, and governance. So sort of interested to see if you guys help support those initiatives or how you kind of work with them when it comes to that diversity and all those kind of initiatives that most of those big companies have in place.
Yeah. So thank you. We started some time ago a DE&I effort in the United States. Around the time that COVID came out, we took a position that the way to move funds to small and mid-sized businesses was to enable their center nodes, their customers, just to pay them sooner. During COVID, a lot of the big businesses in this world slowed down or stopped paying suppliers. It's okay. I mean, the big business was worried about their own existence, but that was very problematic for supply chains. So we took a position, and I wrote it with one of the presidents from the Federal Reserve System, saying this is what we need to do with Main Street loans. We talked to the Fed. They were supportive. We talked to Treasury. We talked to House. Politics tend to move more slowly, but we got some fairly decent traction. And the end result of that was that many of our large private companies, I mean publicly traded, but not government companies, decided to launch DE&I markets for us because in our research, what we found was that Black and brown businesses, MBE businesses, utilized us 5 times more than their majority cohorts. And small businesses utilized us 3 to 4 times more than large businesses. And women-owned businesses utilized us 4 to 5 times more than male-owned businesses. And the reason for this, we think, is that the system today, because it still has to risk underwrite, assigns more risk to those non-majority populations. Because the majority-minority world isn't what it should be, where we are still flawed as human critters, minority populations tend not to do as well and to fail more often. And so the banks have to take that into consideration because the banks have to preserve and not lose their depositors' money. Remember, I ran a bank for a number of years. I understand what the FDIC expects of us. So those DE&I markets have been wildly successful. Last year, we were able to fund, if I remember correctly, roughly $2 billion to diverse women-owned and small, actually not even small, just diverse and women-owned businesses, almost $2 billion. This year, we're growing again at 100+% rate for that, so it should be approaching $4 billion, if not more. So we're very proud of those efforts. I think in Europe, you're seeing, in our European markets, you're seeing more focus on environmental. So we are doing things with large customers there to make sure that the supply chain is environmentally compliant. But the key to all this is if you're going to become environmentally compliant, it's going to cost your supply chain. How are you going to help them with that cost? Well, one of the ways you could help them with that cost is eliminating their need to go to a financial intermediary and be charged too much to risk underwrite. So fast forwarding to sort of to a grand scale or a grand scheme, if it's going to cost 150 to 200 trillion to get carbon neutral by 2050, where are we going to find that money to pay for it? Because the consumer's not going to pay for it. At least I don't think they're going to have the appetite to pay that much. So as a tax to the consumer, I think we risk pushback from consumers as we pass these costs on to them. We should be more focused on reducing cost in the supply chain through all aspects and all angles. One of ours is reducing costs through better transparency and better flows of capital versus the intermediation underwritten and risk-enabled to supply chain. So if we do what we think we can do over the next 10 or 15 years, well, we think we could add upwards of $1 trillion or $2 trillion back to the world's economy simply by making flows of capital more efficient, low cost, and more convenient for the users of that capital.
Okay. And so you launched those during COVID, so that's like 2 years ago, and those programs have just continued to grow, it sounds like.
Been wonderful. The DE&I markets in the United States have been fantastic. And it's really something to see. We have the world's largest retailer running on our platform and funding their DE&I suppliers, literally LIBOR, now SOFR, plus 50 or 60 basis points.
It's fascinating. And that's a big part of my show is obviously supporting. We have a whole month that we dedicate every March to diversity and inclusion. So talking about those programs is interesting. Well, let's switch gears a little bit and talk about you and your journey. So you've talked about being a banker in the past, but maybe pick up from graduation of college to where you are today and walk us through the journey.
I'm far too old to think back that long. So it is interesting when this rather significant downturn that we're in currently, VC, PE funded companies all sort of clutching their stomachs and pulling their hair out. I did send a note to my team. So I believe I've been through at least 7 of these. So my career started in 87. And, you had, I believe, Black Tuesday was in 87, where the Dow was maybe at, was it 1,000 and it dropped to 500? I mean, there have been crises now. That was sort of computer enabled, and there were some challenges there. But there have been any number of scares like this in the past. So it did cause me to realize how long I've been in business. So I started, as I said, I had wanted to work for First Boston because they were sort of the badass investment bank and sort of aspirationally hard to get into. Like one person for every 1,000 applicants or something like that. Didn't make the cut. And happily, because had I made the cut, I would have been let go in the fall of 87 because of the crash. I went into business here in banking in Kansas City, rose happily through the ranks to become CEO when I was a fairly young man. That company is now run by my brother, and it's now a $40 billion bank. When I was running it, it was a $20 billion bank. And in 2000, I retired, handed the reins over to my brother, and decided that I wanted to go build e-commerce companies. Now, that, of course, is very indicative of the top of a market. When you get old school bankers like me thinking it's a neat idea to go build an e-commerce company and stepping down as CEO and chairman of $20 billion organizations to do this, you probably should sell all of your internet stock. And of course, we funded our company thanks to Mayfield and a great crew there. We funded our company in March of 2000. And it was a B2B e-commerce company. And it was called eScout, later became Perfect Commerce. We went through hell and back to make that company survive and eventually got it traded on a public exchange in London. But one of the lessons from that company, we were very close to running out of cash in 2002, but we had done a pretty good job building a big book of business with large companies. So we had a lot of accounts receivable. My CFO came in, said, "You're going to miss payroll." And we couldn't borrow. We couldn't get any more money from the VCs because it was a nuclear winter. But yet we had, $3 million, $4 million of accounts receivable. Payroll is probably $700,000, $800,000. So I got on the horn and started calling my friends, some of whom were pretty good friends at these big companies. And it was pretty harrowing to make those calls, because you're worried about getting put on a credit list or watch list, and you don't know what's going to happen, what they're going to say. And that was one of the aha moments for me, that there was no efficient way to do price discovery, nor a de-risked way for a supplier to request early payment. So when we take that learning and the old learnings that I had from the bank trying to do low-cost, convenient capital, and you pair it with large companies. And I remember sitting with, it wasn't Mr. Senegal, Jim Senegal at Costco. It was Joe Graycheck and, who else was around the table at Costco? But I remember one of the senior leaders listening to me say, "Hey, well, we're going to create this marketplace that's going to clear different prices for your suppliers. We're going to make sure that we sort of manage the supplier to the right price of kind of indifference so that we maximize income for you and also, do a pretty good job getting capital to your suppliers." And I remember being told, "We don't want you to take our suppliers to the point of indifference. We want you to take our suppliers to the point of happiness. We want this to be seen as a supplier benefit." And I thought that was terribly eye-opening, and it became our mantra from that moment on. That was brilliant advice from our first customer. This is about supplier satisfaction, which is why today our net promoter score is 71. We'd aim for it to be 75 by the end of the year, but we want to do business with buyers who see this, center nodes who see this as a benefit for their suppliers and a benefit for their customers.
And that was around 2010 when you started this company?
Yeah, that was 2008, we started writing the code, filed patents. And 2010, I believe, in fact, I know exactly, it was St. Paddy's Day, 2010, was our first marketplace transaction.
Fascinating story, how all that came together to form this company. So what are some things you're passionate about? So maybe one work-related passion and one personal passion.
So work-related and personal, it's nice when the two can come together, is figuring out a way to take care of folks who haven't been taken care of very well previously. So, yeah, it's a long story, and we don't have time for it. But I came out of an orphanage in Chicago, went through a couple of parents, maybe not the best ones, and had a lot of insecurities as a kid. I was a little scrawny little kid, got beat up a lot, slammed into lockers, all those things I'm sure lots of people get. I had a little bit of that at the home as well, and just made me have really deep appreciation for folks that aren't taken care of. And as time passed, I was fortunate enough to kind of get a little physical size to me, and went away to boarding school and then played football up in the Big Ten briefly, but ended up sort of overcoming physical weakness and have thought a little bit about how one does that, not just physically, but how you do that emotionally, spiritually. How do you create ways to support those who are not supported? And whether it was in the banking world, wanting to find ways to get capital, even given the constraints that we had in the banking world, to folks who needed it, rather than just thinking about our margin. I said I was a black sheep in the bank, primarily because I said, I'm not going to measure you anymore on net interest margin. I'm going to measure you on what success you've created for your customers. How is this capital used? How did you grow the business? And so even to this day, now fast forward to C2FO, we don't think much of our net income. It's small, so probably not much to think about there anyway. Our margins are very thin. This is a giant volume business. We think about the amount of funding. You've heard me say that now multiple times. 55 billion of funding last year, 100 billion this year. We think about the number of jobs that creates. So if you apply what the SBA and the Federal Reserve say relative to early payment, they've done some sort of empirical small studies on what early payment does inside their own supply chain. The SBA studied early payment from their government sponsors to government suppliers, and they found that a certain amount of every dollar went to job creation. If you apply that formula to what we've done, this year we'll create over 150,000 jobs just in the United States. And we're giving it to companies, as I said, the utilization rate of small biz, brown and black, MBE biz, women-owned business. Those businesses use us on average 4 to 5 times more than the majority male cohorts. So we're very proud of the fact that we've built something that's helping those who are underserved. So long story short, I'm really happy to be able to see our business doing good things for folks that kind of feel like me back in the day.
Okay. Thanks for sharing that. So this next question, I love to ask to get different people's perspectives. And when I started into this whole fintech payments world 16 years ago, I just sort of fell in it and haven't been able to get out. But this day and age, there's a lot of money being invested. It's a hot, sexy space to be in. Kids can actually take fintech courses. So they're coming out thinking about building a career in this space. So curious what your advice would be for them coming out of college, looking at this fintech payment space. What would you tell them that they should do to be successful?
Other than work harder than anyone else around you is, remain hyper curious. Always ask the questions about why or why not. Right? Those are macros. We value curiosity as one of our key hiring filters. Be extremely curious. Work your butt off. But then I'd think maybe it's because I've been around for a long time, but I like the idea of going to school on someone else's dime, meaning you don't need to go start your business on day one when you graduate from college. No, maybe you can and maybe you should, but I would advise getting smarter while someone else is paying you a salary to get smarter, to be super curious and hyper interested in the ins and outs of that business, whether it's a small biz you're working for, a large business, startup, or a well-established business in the financial space. Learn from them while they're paying you that salary and figure out what the problems are that you want to go solve from your experience inside that corporation. And for me, of course, I guess I'm talking my own book, that is precisely what I did as a banker. So 13 years in the belly of the beast, I kind of got to know what worked and what didn't work. Understood technology probably better than most bankers. So I was able to take the lessons from banking and the flaws of the system, marry it with the ability to be somewhat creative, write the code, write the patents for what we did. No, I didn't write the code. I was helping write the code and give direction to people much smarter than I on code writing, but knew exactly what we wanted to do. And because I had spent time understanding how screwed up the system was generally. So I could have gone to get an MBA and paid for it, but somebody else paid my salary to get an MBA inside the finance space, and I was able to do that, learn, and then build better businesses because of it.
Do you think people learn more at small startups or big companies?
Wow. I guess it depends entirely on the type of business. We are very transparent at our shop, right? We talk about every week, all hands meetings for all 1,000 of our folks. Every month, full financial. Here's what's working. Here's what's not working. Here's what we did well on the OKRs. Here's where we were on funding. Here's where we were on, things that aren't working as well. So I think that was much more transparency than I was able to give my team when I was a publicly traded company at my bank. But I also think there's small companies that are just hyper private and sort of clandestine. And maybe it's because they're not proud of what they're doing or because there's still problems. It depends entirely on the culture of the company. If I'm small, medium, or big, I would work for a company where you have massive amounts of transparency because there you can exercise your curiosity.
Yeah. Yep. I love that advice. Well, Sandy, we've covered a lot of ground on the company, on your personal journey, your vision of the future. So is there anything else you'd like to add before we wrap up?
No, just great to be with you and appreciate the chance to talk a little bit about what we do and why it matters.
Yeah, well, I appreciate that. What would be the best way for people to learn more about the company?
Just go to the site, C2FO.com, and if you're interested in being part of the company, we are always hiring. We added, I think, 500 people in the last 18 months. So we're looking for the very best and brightest that really care about doing the right thing for folks who might not have been taken care of previously.
Okay, that's awesome. That's a great mission and message. So, Sandy, thank you so much for being on the show today. I know your time's very valuable. I really appreciate you being here.
Well, it's a great pleasure. Thank you, my friend.
Thank you. And to all you listeners out there, I thank you for your time as well. And until the next story.
Thank you for joining us this week on the Leaders in Payments podcast. Make sure you visit our website at leadersinpayments.com, where you can subscribe to the show and where you'll find our show notes. If you enjoyed listening, please share on your social channels as well.